the dollar, kind of trades inversely to stocks. And
Towards 293, maybe down towards 315.
People that want it to be back to 2006 heyday.
So I would call up mutual, Fidelity Investment.
Welcome to the Trading Desk, where we say money talks. My name is Dave Floyd with Aspen Trading Group, and with me, as always, Matt Davio of Red Rock Partners and Jesse Felder of Felder & Company.
By the way, the new Trading Desk dance floor is in.
It is? You stole my segue, but that's okay. Before we get into today's show and before you enjoy our wonderful new set here, let's take a look at what the markets have done over the last couple of weeks. We go to the first chart here. Jesse and Matt are always talking about it, or we all are, about using a contrary opinion, and this is basically a chart that shows the number of times the word double dips being used in the mass media right now, and everybody's talking about it.
It's becoming a popular topic, yeah.
Yeah, so I look at that and I'm thinking, maybe there isn't going to be a double dip recession.
Yeah, and this is interesting. This is the chart, basically kind of a Google. When people do Google searches, you can look for this analytics on Google and say, hey, how many times are people using the word double dip in the writing? And as you said, it's kind of gone parabolic, which is kind of scary.
What does that mean then? That's no longer the contrarian view. The contrarian view is either
continued upside.
We're going to see a big recovery, like Jim Grant wrote about over the weekend, or we're not going to see any recovery at all.
Or we're just going to stay right here.
Right.
Yeah.
And again, we all know it's one piece to the puzzle. There's a lot of other things that we all look at, but I found that was pretty interesting.
It is,
so
yeah, for sure.
We'll go ahead into the next slide, and we'll kind of get into some charts here. S&P 500, it's obviously doctored up. I created this one this morning. It's got a lot of labels on it, and we don't really need to focus on that. But the thing that I really found interesting about this chart is that the rally off of the March lows, at least in my opinion, doesn't really have an impulsive quality. And impulsive really means there's
quick,
not quick,
fast.
Decisive, fast action. And this has really been a labored move, and especially if you look at the last few weeks.
And I think you can't really tell here, but this has been a massive rally. We've rallied over 50%.
60,
It's one of the biggest rallies of all times for us in terms of a 6-month rally.
Yeah, but again, we've talked about on the key resistance. If you take the all-time high on the S&P's 1575, drop it down to 666. That halfway spot is 1120, and we're staring. Today at 1070, we're basically staring it in the face.
Not only have we gained over 50%, we're retracing 50% of the decline.
And we also, from a time standpoint, if we want to do a retracement in time. We've basically retraced a big chunk of that move lower down.
Well, again, 2 years down and now almost 8 months up. So
the other thing that I look at that it's not on this chart are the momentum indicators like a MACD and some oscillators.
Not confirming.
They're all declining, showing that basically participation.
So again,
momentum is slowing.
Massive divergence, price up, and indicators as far as momentum failing.
That the prices are not being the higher prices aren't being confirmed by the internal indicators.
Let's take a look at the next chart.
Yeah. This one basically just it drills down a little further. The other one we were looking at was a daily chart. This is a 60-minute chart of the S&P, and we're basically just isolating this most recent leg. And for me, what jumps out on this chart is if we break below 1051, I think we've got a real good shot of.
And Dave, again, you're a chart guy, I'm a chart guy, and you don't trade the S&P like I do every day, but you and I are on the exact same page here. 1050 is the number right now.
We got close this morning, but I don't know where did we close before we got on the air.
Well, we were 1051, and then we rallied back to 1062, so we haven't broke. Maybe this afternoon. But we got the Fed this week, we got FOMC, and we got the G20 starting Friday and Saturday. So again, intervention is upon us all week again.
Sure.
Yeah, lots of
next chart, if we don't.
Dollar index. This is we've been talking about this for a while. This is what really gets me. Again, contrarian view. Number of bulls on the dollar, 3%.
Yeah, nobody's long the dollar. All press is negative on the dollar. Right. Everybody says we're going to heck in a handbasket here.
Well, I think this is interesting for people to see. This is basically the low for stocks back in early March. The dollar, kind of trades inversely to stocks, and so we had this peak of the dollar. And now, as the stock market's rallied, the dollar's been falling off. So they kind of are intertwined. If the dollar does rally, we've been talking
let's take
about
let's take another look at the next chart, because I think we're going to get into gold and interest rates here next. Yeah.
Correlations. If the dollar's going to rally and the S&Ps are going to go lower, gold is going to go.
And again, gold is so bloody obvious on the chart right here. It has broken out, but I think it's going to fail. I agree with you.
Everybody's watching it break out.
I agree. I agree.
We had a couple other charts, but we've got to take a break. When we come back, we're going to continue our discussion. You're watching The Trading Desk on COTV Channel 11.